Hello, ladies and gentlemen. This is supposed to be a sentiment analysis, but the sentiment hasn't really changed from last week. And much of what I'm going to talk about, I've already talked about previously, and that is the obscene level of property taxes crushing the middle class. And the problem with this is really very simple. A lot of governments have drove out businesses. For example, if you look at Boston or Seattle or Portland, the pay your fair share turned into such an obscene level of taxation that businesses have left. We see that right now in California, to the point that the state literally lost $1 trillion through what would have been perceived taxation. This is the problem that we face when the governments get greedy. But rather than correcting, they simply add more layers of bureaucracy. And now that the businesses have gone, they are targeting property taxes. Now the first line of thought is that only affects homeowners. But that's not true, because it also affects renters. When they get their monthly rent, that rent has in it all of the expenses needed to maintain the building, including property taxes. So if the property taxes jump 13% in 30 days, as they did in the beginning of January for Boston, guess what that means to the people renting in Boston? Their rent automatically jumped 13% as well, in order to cover the cost of the property. And if you think rent control is an issue, we can look at New York City for that and see just how badly that is working out when the property owners can't afford to maintain the property. In fact, we could even go to Los Angeles and look at a case of people earning $120,000 to $140,000 a year, not even being able to afford to rent an apartment. They literally have good paying jobs and still have to live in their cars. Think about that. $120,000 a year, and yet because of the prices of rent and the obscene level of taxation, they can't even afford to rent a home. And as more and more businesses leave, California, like all of the rest of the regions we've just discussed, is putting more taxation into property tax, into fuel taxes, into any other kind of tax where they can extract as much as they can. They are building bureaucracies so deep and thick that the only guarantee is that nothing can be fixed until it collapses. If this was my only channel, we would be talking about history and how we've been here before with multiple societies. But this is here and now, today. Right now, this very moment, property taxes crushing multiple people on a constant basis. It's all over the place. It's easy to see, and it isn't getting better. And it's all done deliberately. Governments make choices, and those choices are to continue to bleed its citizens until there's nothing left. As much as I would love to say that's hyperbole, the foreclosure rates, the housing bubble, the number of properties that are still sitting empty in city after city clearly tell a different story. And that is the problem. And all of the government gimmicks to make housing more affordable is going to fail and has failed because they can't control their spending. I read one report last week that talked about California. $40 billion on a high-speed train over the last 40 years. And they haven't even laid one single rail yet. Where'd the money go? What did they do with it that they actually didn't build the train? But that's the problem that we face. And it isn't California. This is in Seattle. This is in Portland, Chicago, Boston, Columbus. I could go city after city after city of how this is deliberate, manufactured collapse. And these states are doing just that. And then when they drive the people out of the state, the people take their toxic thinking with them that created the very problems they're running from. And that only spreads the disease. And that the sane people, the people that just want to try to survive and live life somewhat decently, the people who live in LA County and LA City, who make $120,000 a year living out of their car, just want homes that they can't even afford. They are the people that suffer from all of this. And the bureaucrats, the lifelong politicians, they don't care. So that leaves us to care for ourselves, to think about the market in a way where we can survive what they've done. And that's really where I've been for the last several months, trying to build a system that lets me run simulations, not just 1 or 2 or 10, but thousands of simulations for the sole purpose of actually seeing what works. To be able to take a market that deliberately hides data without you having to pay an extreme amount of money per month, and take that data into several thousand candles, and then test it, and then generate another sample and test it. That is where I've been focusing my research. For example, the Kraken exchange only gives you 721 candles of history. That's it. And in that, you're supposed to make decisions on how to protect your money. That's why I built the script I built and put in the support server, where I could take the highest time frame, those 721 candles, and I can use a lot of mathematics, and I can create a real market based upon that I can then run through a simulation. And then I can repeat that process 10,000 times and actually see the combination of real market data and several thousand simulations how well my strategy will survive. That's where we're at right now with the sentiment analysis. It's past the point of trying to figure out the government, because we can clearly see what the government is doing. Now we need to think about what we can do to help ourselves. And that is what I have done here. This is an example of that work. Everything I have built over the last 3 months, the technical analysis library, the candlestick simulations, all coming together in one simple force. The ability to see exactly what we are doing. The irony of this data is that I can simulate so much data that I can actually guess a real market from my simulation. And that is the uniqueness of this approach. What we see on the screen is that culmination. So let's start and actually talk about what we are looking at. We are looking at the starting date of the simulation, the ending date of the simulation. Now you'll notice that this is dated March because it's completed the entire cycle of the period. The last period is 2 weeks, and so for this simulation, it filled out all of the rest of the information. We have the asset that we're trading, and we have the maximum open positions at a single moment. Now this is a DCA-based strategy. In fact, this strategy is the savings account strategy. My most popular, most powerful. Always in, and yet it does extremely well. So we have here a framework that lets us actually test the market. The maxima open, and we can see through these tests exactly what our worst case scenario is going to be, what our best case scenario is going to be. We will see several flat markets, bear markets, bull markets. We get the idea of exactly what we need. The maximum purchases or maximum buys per trade cycle. We see exactly what that run did and how well it did. The higher the maximum, the more bearish the market. We have a conclusive way of looking at the market in a deterministic point of view. The maximum number of purchases per trade cycle. So we could even see exactly what our averages are going to be. So every trade cycle is going to average around 2 purchases. That is an acceptable level. We have the way of looking at how many or how deep our exposure is going to be, because we see between the maximum buys and the buys per trade cycle. For example, in this case, 16. Well, if we have $10 per position and we have a maximum number of open positions, we have $160 of exposure. We can see that we have 2.3 buys per trade cycle. That gives us a good idea of what we can expect, along with how that correlates to the frequency of us hitting higher numbers of purchases. We can begin to statistically see and model a worst case scenario. When we look at the number of buys, we can see, for example, 163 buys. And we can see, in this instance, 63 sells. So we can begin tracking all of that information. And then we get to our actual important part. Profit. P&L, the part that matters. How much money can this make at the end of the shelf life of this cycle? So we see here that a P&L of 22. Now, the basis I used for this, for extrapolation, is 1 unit per purchase at market value. So if a unit like Ada is $1.50 and it made 2 to 3 purchases, let's just use 2 for simplicity. $1.50 times 2 means my average purchase is $3. Now that $3 on average made me $22 of profit. We have a consistency. Then we see the average P&L, which is how much did I make per trade. That's important. I made 11 cents or 13 cents or so forth. We can see a consistency in the model. And now for the parts that really matter. The number of days between purchases. The algorithm goes 17 days before it makes another purchase. And now for this particular model, this is with a 2% take profit and a 2% deviation. So it makes a purchase every 17 days on this particular run. But the days per sell are 1 sell, 1 completed trade cycle every 42 days. So again, we have a clear, determinant, statistical way to understand what we are doing. And for this particular system, the trades were 2,700 days. Now we can go back to the beginning and actually see the date involved. So for 2018 to 2026, is this sample market? Roughly 7 years. So for 7 years at 1 unit market value, we made $22. So by using that extrapolation, $10 per unit would have been $220. But by being able to run this simulation thousands of times, we have a process that now tells us how to survive the market. We know how many buys we need. We know how many sells will take place. We can formulate a worst case scenario. We know that if we have 2% deviation, that deviation is based on the highest high. We have a worst case scenario of 50 positions. If our position size is $10, then that means our worst case budget is $500. We have a consistency that we can build on through the savings account that will survive the market with the exception of liquidation. We can get a clear view of exactly what we are looking at in the model. So after running 100 samples, we have a consistency of being able to actually model our worst case scenario based upon real data and simulated data. The real data makes sure we follow the highest time frame so that our simulated data produces reasonably well and consistent representations of what the market can actually do. That is important. So that is the sentiment that I think we need to convey about the market. We've already seen and I've demonstrated how the news has been manipulated to push an agenda of fear. I have demonstrated mathematically through the charts for Forex, stocks, and crypto how those markets have been manipulated to push an agenda of stability. So somewhere in between those two spectrums is the truth. This is where we find that truth. By looking at the average of all of these simulations, by seeing and building on this, by understanding what we are actually looking at. For example, right off the bat, we can see some things. Days between buys. Well, days between buys, the lower that number, the more volatility there is in the market. Whereas the higher the number, the longer you wait to get into the market, the flatter the market is. Days per sell also is an indicator of volatility. If you are able to sell more frequently, you're able to move in the direction of the market more readily. That suggests a volatile market, and in this case, because the model is a long position spot market, it suggests an uptrend or a bullish market. Lower days per sell implies more rapid sells. Higher days per sell implies more time required, flatter markets, longer markets, stagnation. So you have here metrics that describe your market. But because this is rooted in the 2-week historical framework, that is 2 weeks of data per candle represented out over 700 candles, you have a framework of consistency of observational expectancy. So let's go back and look even more closer. Maximum buys per trade cycle. This is important because it clearly shows you exactly how the market is performing. A higher number of maximum buys means more accumulation, more exposure. You can clearly see how this shows. Less accumulation, less exposure, less profit. They work hand in hand. So you don't want too aggressive of a market, and you don't want too stagnant of a market. The highest number of maximum buys per trade cycle implies a bearish market. The lower values of maximum buys per trade cycle implies an extremely bullish market. So you could either get depth and profitability, or you can get rapid and little profitability. For example, if we take the average P&L and we multiply it by the maximum number of buys per cycle, that gives us a clear representation of profitability. We can see how that differs than the average number of buys per cycle. For example, let's take 2 times 14, 28 cents per cycle, but 14 for the maximum buys. Well, that's $1.40 on that cycle. So you can get a clear idea of a rough estimate of exactly what you are looking at for profitability through these simulations. You could actually turn profit into a determinant factor based upon what you're seeing, because you know your fees, you know your injuries, all of that fits in such a way that you have basically taken an unpredictable framework and turned it into something that is completely predictable, completely mapped out, and completely consistent. And that is how you beat the market. That is how you actually take a situation that is completely against you and turn it around. Not by gambling, but by using statistics, real statistics, in your favor. Not by playing guesswork, but by calculating your options. This is the direction I have been focused on the last 3 months, extremely aggressively, but even prior to that, over the last year, as I have been building Relay, I have been moving more and more towards this kind of functionality, being able to build models that give real answers, real statistics that help you make real decisions. You can clearly see exactly what you need. You know the number of days between buys, the number of days between sells. You can begin to see an average form. That average helps you decide whether or not a pair is in a bullish market or bearish market. Here it looks like the average of, I'm going to say probably, let's just go with 10 for easy numbers right now. So if we have an average of 10 for our maximum buys, well, then anything less than 10 is going to signify a bullish. Anything more than 10 is going to signify a bearish. If we do this simulation across 100 times, and we do this for several assets, then we can begin to combine and correlate this information in a way that once we see where we're at, we can see which assets are more likely to be more valuable and profitable versus assets that are going to likely stall out and take longer to get rid of. We can find that happy medium based upon our own risk assessment. And that really is what this is about. Being able to take and manage risk. At any point, now that you see where I'm going with this information and why things have slowed down somewhat behind the scenes, this is the direction I'm moving. Being able to get real information, not useless statistics. Let me know what you think. Share your thoughts. What has trading been like for what you have been trading? Have the assets been stable or unstable? Let me know. Leave me a comment. Post something in the support server. What assets are you trading? And let me run a simulation on them to really get an idea of what the market is like. Now, after I'm done making sure this program is correct, I will be releasing it on the support server in the technical analysis area. Thank you for watching.